Good morning, everyone, and welcome. Thank you for joining our webinar. We're absolutely thrilled to have you join us today. We've got a great mix of well-known clients and contacts and some new people too. So huge thanks to you all for taking the time to be here. Let me start with some introductions. My name is Avril Craig. I look after payroll. I'm the payroll director here at Henderson Logie. I look after the payroll for around about 500 clients across Scotland. Myself, not just me, my team of 12 people in the payroll department. So we take care of payroll, auto enrolment, employee payments, and various other things. As I say, for around 500 clients. Today, I'm talking to you about national minimum wage compliance. I'm joined by my colleague, Richie McPhee. Now, Richie is one of our tax managers. He's based in our Edinburgh office. He looks after our corporate clients and he has a special interest in employment taxes. And today, Richie is going to be giving us all an update on what's happening in the world of payroll benefits in kind, P11D, P46 Car, and all associated matters. So here's our agenda. We'll start off by talking about minimum wage. I'm going to give a little bit of background. I'm going to talk about the most common traps and pitfalls, because to be honest, there's come across a number of clients who are in breach of minimum wage and they don't even realise it. So the point of today is to raise awareness of how this can happen and what you can do about it. I want to also talk about what HMRC are doing about enforcing compliance. I'm going to tell you about, as I say, how you can prepare to keep yourself safe. Once I've finished, Richie is going to talk to us about payroll benefits and kind in P11D. He'll give you the lowdown on the latest position with PBICs, P11Ds, P46 cars. There is a bit of a confusion going on at the moment because things have changed and changed again. So hopefully Richie will give us all some clarity on the topic. So let's start with national minimum wage. I thought I'd begin with sharing some recent press headlines, and I'm hoping that will grab your attention. This is essentially why we're talking today, because these things are happening. Businesses are being fined, businesses are being named and shamed, and there's such a big increase in compliance activity. And the whole time I've worked in payroll and since national minimum wage began, I don't think I've seen anything like the degree of activity that's going on now. And when you look at these press headlines, you'll see organisations like Holland and Barrett and British Gas. Chances are that the breaches that people are getting caught out by they're caused by reputable organisations making innocent errors rather than deliberate underpayment decisions made by some dodgy operation. So it just goes to show how easy it is to happen. I'm going to go into that in a bit more detail just shortly. First thing I wanted to do, though, was to tell you about the Fair Work Agency. Now, this is part of the Employment Rights Bill that's due to come in force in April 26. As I say, it's called the Fair Work Agency. And what that is a new state enforcement body. And what it's there for is to centralise enforcement of employment rights, support employers in compliance, protect workers for exploitation. Now that's still being developed, so it's not a finished product, but the Fair Work Agency is definitely something that will be in place. Part of the remit of the Fair Work Agency is to enforce minimum wage compliance. So it kind of lets you see that compliance on minimum wage continues to be high on HMRC's agenda. So, current minimum wage rates. I just wanted to quickly cover these. If your employees, as you know, these reset every April, they're updated every April. If your employees are aged over 21, the rate's 12.21. 18 to 20-year-olds, the rate is £10 per hour. Under 18s and apprentices in their first year of apprenticeship, under the age of 19, their hourly rate is £7.55. Now that's all very clear and very easy to understand. However, to quote HMRC themselves, minimum wage is more than just the pay rate. That's one of their strap lines. So what are HMRC looking for? They basically want us to monitor minimum wage compliance on a regular basis. They want you to look at your payments and hours worked every payday. So how we do that is, first of all, they like you to categorise your workers so that you know which is the appropriate calculation for each type of worker. The types of worker we have are those that are paid for time, so X pounds per hour. We've got those that are paid per unit they've produced per output. We've got salaried employees who are paid an even amount every month or every week, regardless how many hours within their contracted hours they work, because we all know that months are uneven and a year isn't exactly 52 weeks. Then there's unmeasured work, and that really covers employees that aren't covered by the first three things, so maybe quite nuanced, unusual situations. So we've categorised the workers, then we have to do the correct calculation for each different category. However, there are things that you must include in that calculation that can impact whether an employee is paid above or below the minimum wage. And this is what I'm going to come on to. So let's look at what could impact the minimum wage calculation and compliance for minimum wage. I've listed here the most common pitfalls. In fact, the top 11 that come to mind. There's probably more that I've not thought of at the moment, but I'm going to focus on what I see as the first two, the most common things where it can go wrong. So, unpaid working time. This is really where you've got employees, perhaps they start 10 minutes early. You say your starting time's 9 o'clock, but I want you at 10 to 9 to switch the lights on, get your workstation ready, and so on. And then the same happens at 5 o'clock. They finish work at 5, and then they have to power down, and then they go. So that's another 10 minutes at the end of each day, and that counts. As far as HMRC are concerned, that counts as working time. So another example is travel between sites. If your employees go from client to client to client, and I've seen that in the community care sector, you have to pay them for the time that they travel from appointment 1 to appointment 2. Another area is mandatory training. If you're saying to your employees, we want you to do these online modules, but do them at home, not in working time, that's working time. And that time has to be included for minimum wage calculation. You don't necessarily have to pay them for that time if you made agreement not to, but it has to be included in the calculation to assess whether your employees are paid above or below minimum wage. Now, I've got a couple of very simple examples here. Let's say you've got an employee who gets paid £500 a week and they work 40 hours a week. That's £12.50 an hour. That's above the minimum wage rate, so we're happy. But let's say that same employee comes in early, maybe works through lunch a little bit, finishes at 5 and then has to close up and put all the lights out and lock everything up. It's another 15 minutes. That's working time as far as HMRC are concerned for minimum wage purposes. So then what we have to do is add that extra working time. Let's say it's 30 minutes a day and their working time in the week ends up being 42.5 hours. They will have a minimum wage breach because you've paid them £500, but they've only worked they've worked 42.5 hours and their effective rate for minimum wage is £11.76. Salary sacrifice schemes is another common one. So salary sacrifice things are childcare vouchers, holiday purchase schemes, cycle to work schemes, salary sacrifice pension. These sacrifice amounts all lower the pay for minimum wage purposes. So it's the post-sacrifice pay that counts for minimum wage calculation purposes. I've actually seen a case where someone, their salary was £60,000 per annum, and once all the sacrifices were taken off, once all his extra hours were added, he was actually paid below minimum wage once you did the full calculation. And this is why it's really, your first instinct would be to think, oh, someone earning 60,000, there's nowhere they're near the minimum wage levels. But once you take all these things into account, potentially they could be. Another simple example, I've got the same person, £500 a week. They work 40 hours a week. They're getting £12.50 an hour. Let's say £100 goes into salary sacrifice for pension. That means that their wage for minimum pay calculations is £400 a week. So if we're dividing that by 40 hours, their effective rate for minimum wage is £10. So once again, you can see how easy it is to fall into a trap where you're, without realising it, paying someone below minimum wage. These other things can also create minimum wage breach. Incorrect deductions. By that I mean, obviously you take things like tax and national insurance off of pay, and that doesn't affect minimum wage. If you've given your employee a loan and you're deducting it back over 6 months, things like that don't affect minimum wage calculations. But the things that do, if you supply a uniform to your employee and you deduct money from them to pay for that uniform, that deduction should be subtracted from the full pay to give you the wage for minimum wage compliance. There's other things, tools. If you're giving them tools and they're paying you back through deductions in pay. If, like a leaver, you've clawed back some money from them because you've provided mandatory training, and it's in your contract that if you leave before a year's up, you'll take some money back. That can affect their wage for minimum wage purposes. So I would say the main things are unpaid working, salary sacrifice schemes, and correct deductions. But it goes on. I've seen people saying, oh, well, pay a gym membership for this person, so I'm counting that into their pay for minimum wage. Things like that don't count. Occasionally we'll see people forgetting to update the hourly rate when someone turns 18 or 21. Accommodation offset. If you work in the hospitality industry, you might provide your workers with accommodation and say, I'm giving you a lower pay and accommodation and that covers minimum wage. That's okay, as long as it's within the correct parameters. So you have to do the calculation to make sure the accommodation offset rate plus the minimum pay, the wage that you've paid them is enough to be compliant for minimum wage purposes. So maybe you're starting to see that you've really got to look at this carefully for each different scenario to make sure you're checking things correctly. We see other things like salary miscalculations, pay reference period mismanagement. If you're paying someone for hours that they've worked, but you don't pay it to the next month, that means that month where they've been short of hours could be a minimum wage issue. Overtime and bonuses, you can't, if you pay someone time and a half or double time, that extra allowance on the rate, that enhanced rate, the enhancement on the rate does not count towards minimum wage for the other worked hours. Same with a bonus. If you pay someone a bonus in June, but they earned that bonus in May, that cannot count towards their minimum wage in June. Neither can an annual bonus because it has to relate to the period that it was earned. Worker category misclassification. I touched on that earlier. You have to know what kind of worker you have, and if you've misclassified them, you might be doing the calculation wrong, and therefore you could be making an error. Now, that's top 11 pitfalls that come to my mind that I've seen, some more than others. Depending on your circumstances and your own organisation, there might be other things. So you have to have a very careful look. Don't just use this as an exhaustive list. Perhaps we're going to see how easy it is to fall into the trap of being non-compliant for minimum wage purposes. Now, speaking of compliance, what are HMRC doing to ensure compliance? The truth is, HMRC's enforcement budget has increased significantly in recent times. They're increasing compliance check for national minimum wage, and the Fair Work Agency that I mentioned augments that. The role is to ensure employers are paying their workers at least the appropriate rate, which I agree with, and it's fine. And it's right that they check. But there's a difference between innocent error and deliberate underpayment. And this is really what I'm trying to flag to everyone. Make sure you're not making an innocent error, because even if you do, even if it's an innocent mistake, you still have to repay and you could potentially still be fined. So HMRC are, their initiatives include self-review processes where they're encouraging employers to check their records to ensure that they're compliant. As I say, the enforcement activity has been heightened. They're doing things like targeting certain regions or certain sectors in the community. We see a lot more preventative education coming out, webinars and online campaigns highlighting the issue. They'll issue nudge letters to employers, basically saying, we suggest you have a look and make sure everything's okay. Because the truth is, if you do self-review and you find the problem and you fix the problem correctly, HMRC are going to go easier on you than if you do nothing and they come along and find it out. A full inspection from HMRC can entail a really deep review of your records, interview with your employees, interview with your staff. If they find underpayment, what you have to do is repay the employees, and it's the difference between what their effective minimum wage was, like in that calculation I showed you earlier, between that and the current rate of minimum wage. So X hours times the difference between the current rate and whatever that rate worked out to be when they calculated it. So repay employees, and also there's potential for fines, and it could be as much as 200% of the underpayment, and it could be as much as £20,000 per employee. So perhaps you could see that getting ahead of an inspection is the right way to go. Employers then, they need to have an action plan. So what's your action plan? Again, it's not an exhaustive list, because every business is different number of employees, different risk areas, different elements to pay and working and so on. So you really have to assess your own circumstances. I would start off with confirming the pay rates. Verify all your employees receive at least the correct national minimum wage rate for their age and category. You update the rates when employees hit age milestones. Identify your worker categories. Classify each worker correctly, whether they're time work, salaried, output, unmeasured, and do the appropriate calculation for that category when, periodically, to make sure that you're compliant. Audit your pay reference periods. Check the compliance pay reference period. Now that's weekly or monthly. So HMRC It's slightly different for salaries, which we'll go into, but in general, HMRC look at each individual pay reference period to ensure that minimum wage has not been breached. You can't have a payment from a previous period offsetting a current period breach. Another thing to do is review working time records. And this is what I mean about unpaid working time. You want to be able to convince HMRC that you have captured all this unpaid working time. Because if you say to them, employees work 9 to 5, but then they interview your employees and they say, well, there's an unofficial arrangement that I have to come in at 8:45 to switch the lights on and power everything up. They'll take that evidence from the employee to make assessment that there's unpaid working time. So make sure you've got a good record and you've captured all the information on unpaid working time. Pre and post shifts, someone working through their lunch, travelling between sites, not home to work travel obviously, but maybe home to a temporary workplace, all that sort of thing, all that time counts as extra, or rather unpaid working time. Another thing to look at is deductions. Things for deductions for uniforms, or maybe they've bought some products from your business and they've got an account running. That's a minimum wage breach. If they've, just say you run a shop and they buy things out the shop and you add it up and take it off their pay, it's a minimum wage breach. I've seen it happen with a lottery syndicate as well. Deduction for meals, tools, there's lots of different things. Some things do reduce pay for minimum wage and some don't. Particularly salary sacrifice arrangements. As I say, that's one of the most common areas where people fall foul. They don't realise someone wants to put a big chunk of their salary into pension. But you have to divide the post-sacrifice pay by the hours that they've actually worked to know if you are or aren't compliant for minimum wage purposes. Accommodation charges, if you're in the hospitality sector, again, there's a special calculation that has to be done to make sure that your employees' pay and accommodation together is above the minimum wage rate. So you've done all these checks. I would really recommend that you maintain good detailed records to record working time and pay, and that HMRC can go back 6 years. So you really should have that for the current year plus the previous 6 years as complete years as well. Ensure that you can demonstrate that you've checked compliance and you are compliant for each pay reference period. Apprenticeship pay. Again, it's easy to forget that someone's gone over 18 or they're past their first year of the apprenticeship. Or is it actually a proper recognised apprenticeship? You're not just happen to be training them. That's different. The apprenticeship rate doesn't apply there. So just keeping an eye and reviewing that as well. Be worth getting a system to conduct internal compliance checks, probably each pay reference period or at least periodically. HMRC have got minimum wage calculators online, but I think most people can create a system that's geared towards their own circumstances for checking everything. And lastly, prepare for a minimum wage inspection. We really think that, you know, being prepared in advance is the best course of action. Have perhaps you've got a named compliance officer, you've got a suite of data ready so that if they do turn up, you can say, here you are, here's all our records, we can tell you everything, we've checked everything, we keep a note of all that's going on. And lastly, and I think this is what I see going wrong sometimes, don't rely on your payroll process alone for minimum wage compliance, because the guys that run your payroll, now it might be people in house, It might be Henderson Loggie's payroll bureau that I look after here. You could have another service provider. They don't have the full picture. They don't know about unpaid working hours, for example. They don't know about deductions that are maybe not happening through payroll, but outside payroll. They don't know about what's going on with travel. We can see the rate, we can see the hours, so there's a certain degree of comfort that we can give you and help. When I say we, I mean anybody who's doing payroll. So this compliance checking system needs to sit alongside but outside payroll, if you see what I mean. So just wanted to raise awareness of that you can't just say, well, they look after payroll, they should know how much they're being paid. Going back to that statement that HMRC make, it's more than a wage rate. Right, I'm going to finish up here and hand over to Richie in a second. I just wanted to give you a little summary of my key takeaways. The watchword really is awareness. Excuse me. Be aware that minimum wage compliance is so easy to get wrong without realising it, and the penalties are hefty. It's more than just the pay rate on its own. HMRC increasing the checks, please be aware of that. Develop a robust system of review and checking, and if errors come up, correct them. If HMRC write to you with a nudge letter or something, reply promptly. Just be prepared for have all your ducks in a row, if you like. Be prepared in case an inspection does happen. There's also certain insurances available to cover the professional fees for helping with a minimum wage compliance check. So that's possibly something that you consider if you feel that would be a help. So it's not the cheeriest webinar, but I just really wanted to give you all a heads up and raise awareness of looking beyond the pay rate and making sure that you're safe. So thank you very much for listening. I'm going to hand over to Richie now.
Thanks, Avril. Thanks everyone for joining. As Avril said at the start, this is really an update on where we are with payroll benefits in kind, following on from our webinar earlier in the year. So I'll just get started. The current position when it comes to benefits in kind is obviously that employers have the option of submitting P11Ds or reporting benefits in real time via payrolling benefits. That's still an option for them. If an employer wishes to voluntarily payroll benefits, they must register their intention to do so with HMRC before the start of the tax year. You cannot register for payrolling benefits partway through a year. If an employer has not registered to payroll benefits, then obviously as things stand, then they just report any benefits provided to their employees via the normal course, which is the P11D forms, which are submitted by the 6th of July following the end of the tax year. This is something that is quite an important point that not everyone fully appreciates. Whether you payroll the benefit or you do a P11D for your employees, the employer still has to submit a form P11DB, and the reason for that is because that's how the revenue capture the Class 1A NIC that's payable, and then the employer just goes ahead and makes the payment of the Class 1A as usual on the 22nd of July following the end of the tax year, whether or not the benefits have been payrolled or they're on a P11D. Having this split system can cause timing inefficiencies, cash flow misalignment, and end-of-year reconciliation burdens for employers, and that's part of the reason that the revenue have made more of a push towards bringing in payrolling benefits and making them mandatory. So that's the current position as it stands. So you've got the option between the two. Now, what is changing? So obviously, we'd mentioned in the previous webinar that payrolling benefits are becoming mandatory. And for mandatory payrolling benefits, what that will mean is that most benefits and any taxable expenses must be reported and taxed via payroll in real time. And that would be done through real-time information and the full payment submission returns that you're currently doing. There are some benefits that are exempt from payrolling benefits in kind, and I will come on to the scope of what's in and what's out of payrolling benefits on a later slide. But just be aware that there are some exceptions, so not all benefits will be reported via payrolling benefits. Some will still have to be reported on a P11D. The big difference with payrolling benefits when it becomes mandatory is that, as well as the income tax, the Class 1A national insurance will also be collected via payroll, whereas currently, as I'd said previously, the Class 1 on benefits was collected when the employer submitted the P11DB. The revenue do appreciate, obviously, that when you are payrolling benefits in real time, there will be in-year fluctuations, or there may be difficulty in calculating the value of the benefit. So they do expect that there will be some instances where estimates are used, and provided those estimates are reasonable, they will accept that, as provided that the employer makes adjustments before the end of the tax year to make sure that the correct annual benefit is reported in the given tax year. So as I said, there are things that are in and out and outside the scope of payrolling benefits. So the next slide just talks about that. So from April 2027, payrolling benefits is mandatory, and that will capture most non-cash benefits. So for example, private medical insurance, company cars, gym memberships, non-exempt subscriptions, that type of thing will be captured by payrolling benefits. So rather than doing on the end of your P11D, there'll just be a monthly amount going through payroll, assuming that the person's paid monthly. Same goes for taxable employment expenses that were previously on the P11D. So the classic one would probably be entertainment. Sometimes that's on the P11D. Again, rather than it being on a P11D, it will just be reported on the payroll in any given pay period. It is expected that there will be additional reporting on the full payment submission that will include these benefit data fields, but as yet the revenue have not confirmed what those fields will be, which is part of the reason that payrolling benefits, which was previously due to become mandatory from the 6th of April 2026, has been pushed back to the 6th of April 2027. So as I said, there are some exceptions to mandatory payrolling of benefits, and those for the moment are employer provided living accommodation. So if you're providing any employees with accommodation that's not exempt under the revenues 3 exempt criteria, then that will still need to be reported on a P11D rather than payrolled monthly or whenever you're running your pay cycle. As well as employer-related accommodation, interest-free loans will also be included on a P11D rather than payrolled. Essentially, these two are the ones that use the HMRC's official rate of interest. So I suspect that part of the reason is also because the revenue may decide to fluctuate that official rate of interest in any given period. But at the moment, those are the two main ones that are excluded from payrolling of benefits. And globally mobile employees or employees who have a modified PAYE arrangements, these are still excluded from mandatory payroll of benefits, but the revenue are considering how to handle these cases. And I would also say that when you look at the HMRC guidance, it gives the impression that you can payroll living accommodation or interest-free loans, but when you actually go into register to do so, it does not give you that option. So a bit of a miscommunication on the revenues part there, but as things stand, I can say that accommodation and loans are outside the scope of payrolling benefits. But in years to come, I suspect it will come in to payrolling benefits. So just to give you a timeline and key dates of the reporting requirements ahead. So, as I'd said previously, it was expected that mandatory payrolling of benefits would come in from April 2026. In April 2025 of this year, the revenue decided to delay that. So now it's coming in from April 2027. So obviously, as it says there, from the 6th of April 2027, employers will need to mandatory payroll most benefits in kind. For the year ended 5th of April 2027, of course, if you've not already voluntarily registered to payroll your benefits, you will still go ahead and submit your P11Ds for the year ended 5th of April 2027, and that would be done on the normal due date of the 6th of July. The payment of Class 1A, whether you payroll benefits or you submit P11D, the P11DB will still need to be submitted by the 19th of that month, and the payment of Class 1A will be made by the 22nd on the assumption that you're paying electronically. The revenue, say obviously if you're paying by check, they have to receive the check by the 19th. Given that this is a departure from the revenue of what has been in place for a good number of years in terms of P11Ds, the revenue are expected to take a soft landing approach when it comes to payrolling of benefits. And that's actually in part of their the guidance that you see on the revenue. So it's something that they are aware that it's going to happen, that people will make mistakes, but as long as they're not big mistakes, they will take a reasonable approach when it comes to the potential issuing of penalties. So one of the main things that will change under payrolling of benefits is to do with company cars and how they're reported. And I just want to go through how things stand at the moment whenever an employer gives a car to one of their employees by reason of employment. So currently, if an employer provides a car to an employee, the first thing that employer should do is submit what's known as a P46 Car online form to HMRC. The P46 Car online form, it's similar in terms of the information that you have to provide to HMRC. It's very similar to that's reported on a P11D. So for example, the list price of the car, the CO2 emissions, the engine capacity, the CC, the fuel type, and the type of car and list price is the same. What people should be aware of is that this has been a mandatory requirement for employers to submit these forms to HMRC, and that's been in place since April 2018. And if you don't submit the P46 car form, the revenue can levy penalties for non-submission, and the revenue's website states that penalty is usually between 100 and 300 depending on the level of late submit or the number of late submissions. That's what the revenue's guidance says. What I would say in practice, that personally I've not come across them levying penalties for non-submission of P46 cars. And that's not to say that they haven't, it's just been my experience that they've not, provided obviously that the employer goes ahead and submits the P11D, because ultimately it's all about capturing that information. But the reason that the revenue like employers to submit the P46 car form is because as soon as that P46 car form is submitted, the revenue will update that employee's coding notice to include the company car in there. That allows them to essentially collect tax, but as well as submitting the P46 car form, the employer is still required to submit the P11D reporting that benefit at the end of the tax year. Provided that the employer has submitted the P46 car form and HMRC have processed that form in time, there should be no additional balance of tax due for the employee. There may be instances where there are some taxes due, but that would only be where the car was given quite late in the year. So if the company car was given in March, for example, it doesn't really give the HMRC time to change the coding notice for that employee to pick up that 1 month period of having the company car. So there could still be a balance of tax due. But if you give the car to an employee halfway through the year, provided you've submitted that P46 car form, the revenue would update the employee's code notice, and essentially the tax would be collected pretty much in real time. But if it's not if the P46 car form is not submitted, or again if the revenue haven't processed it in time, the employee themselves actually will have a balance of tax due at the end of the tax year. That balance of tax due may or may not be able to be collected via a later year adjustment to the employee's tax code, but more often than not, the revenue will, depending on obviously the amount of tax, they'll almost certainly issue a demand notice for the unpaid tax. So with mandatory payrolling of benefits, the big change will be that once an employer registers for payrolling of benefits, if an employee currently has a company car deduction going through their coding notice, they should remove that from that employee's coding notice. Now, I've said in there should. It is obviously on the employee to make sure that their coding notice is correct, because obviously as employers you have to use the coding notice that's been provided to you for that individual. So it's important that when an employer is registered for payrolling benefits, to make their employees aware that most, if not all, of the adjustments that are currently going through their coding notice should be removed. Obviously, as I said before, if you're payrolling benefits, the employer no longer needs to submit the P46 car form because they're taxing the car in real time anyway. The P46 car form was essentially the revenue's way of making sure that the correct tax was collected in the correct tax year. But by payrolling the benefit, the requirement to submit that P46 car form to affect the change on the code notice is removed. Therefore, there's no longer the need to do that form. As I said, once the employer has registered to payroll benefits, if the employee has a company car adjustment in their current year coding notice, that will be removed in the next year. So let's say an employer was to register to payroll benefits today. From the 6th of April 2026, that employee's code notice, so their code notice for the 26-27 tax year, would no longer include an adjustment for the company car or any other benefits that the employer has registered for. What this will mean for the employee is that, assuming that they've got no other adjustments going through their code notice related to employment income or anything else, most individuals will be on a normal tax or standard tax code, which would be the 1257L for UK taxpayers or an S1257L for Scottish taxpayers. Obviously, if there are other adjustments that are not related to employee benefits, so for example, if someone's got an adjustment going through for pension contributions or for rental income, as some people have an adjustment to their personal allowance for rental, those will still remain in place, but it's any benefits that are associated with that person's employment that will come out. If the employee has an adjustment in their coding notice in a later year for unpaid tax in a previous year, obviously that will still remain in place, but it's just really the in-year benefits that come out. As I said, assuming that they've got no other adjustments going through their coding notice, and they've just got employment income as company benefits, because all the benefits are being payrolled, there should be no balance of tax due on those benefits. And I've said they're car benefits, but ultimately it applies to all benefits really. So that's how essentially the P46 car form and P11Ds are going to interact with payrolling benefits. So the next one I want to talk about is the other benefits that are going to come into payrolling benefits. So for example, the other classic one we would see is private medical insurance. So currently, obviously, unless you're payrolling benefits, if you provide PMI to your employees, that's just reported on the P11D, and it's the amount that has been paid covering a particular tax year. Under payrolling benefits, communication with your PMI provider is going to be key. And the reason I say that is I'll give an example of an employee who leaves an employer on the 15th of November, but the employer doesn't notify their provider until the 18th. The employer pays the monthly premium for that employee on the 1st of November. And obviously, because the employee left partway through the previous month, when they come to pay their provider on the 1st of December, the employer will be reimbursed, but the amount that the employer will be reimbursed will almost certainly be based on when the PMI provider was notified rather than when the employee left. So that could lead to an increased cost to the employer that doesn't actually need to be paid. So essentially what my point here is that if you do know of an employee who's going to leave, make sure you're making your PMI provider aware quickly so that any adjustments are calculated in real time and the payment that you make reflects that. As I said previously, obviously P11Ds and P11DBs will still be retained for excluded benefits, loans, accommodation, modified payroll, etc. But ultimately, payrolling of benefits will remove P11Ds for the majority of employers. And because of this, employers are going to need to have a process to reconcile estimates versus actual. And as I said previously, the revenue do accept that there will be adjustments in later periods where estimates have been used. But provided you make those change before the end of the tax year, the revenue are intending to take a relaxed penalty approach. But I would say that standard real-time information lateness and filing penalties still will remain applicable. So obviously whenever there's a new system, there's risks and challenges and things that can be done to mitigate those risks. This slide really just covers some of it's not an extensive list, but it covers some of the main points I think that will come up. Obviously, one of the big things is about software not being ready, and obviously that would have an impact on the employer reporting the benefits correctly and on a timely basis. Our recommendation would be to speak to your payroll provider early and make sure that actually that their software is going to be good enough to actually do this to do the reporting. I'm not going to go over all of them because I'm obviously conscious of time, but everyone, you will all be provided with a copy of this recording, so you can obviously look at these in more detail if you wish. So what should employers do next? I think the most important thing that employers need to be aware of is they need to review their current benefits in kind and expenses schemes to make sure that they're going to be fit for purpose when it comes to this mandatory payrolling of benefits. You may also wish to consider voluntarily registering to payroll benefits early. So as I said, you must register before the start of a new tax year. So the earliest would be for the year ended 5th of April 2027. But you would have to register before the 6th of April 2026 in order to payroll for that year. Doing so just allows you to have a full year of actually getting your systems in place for collecting all this information and making sure your processes are actually fit for purpose and giving you more practice at it. Or, obviously you can wait until it becomes mandatory because obviously there will be some teething issues on the revenue side as well. So it's really up to yourselves, but I'd say certainly consider voluntary payrolling early. As I'd said previously, make sure that your software provider or your payroll provider is actually going to have sufficient payroll software in place that actually meets HMRC's requirements. Improve your capture, valuation, and reconciliation of benefit data. I've said improve, but again, that just goes back to make sure that the collection of your benefit data is fit for purpose, then just test that. The other point that's really going to be important is to actually communicate this change of payrolling benefits with your employees. Obviously, if you're currently doing P11Ds and the employees are getting adjustment through their coding notice, that will all change once mandatory payrolling of benefits comes in. Instead, they will just likely have a line on their pay slip that says benefit, and it could be car or it could be private medical insurance, but they're no longer going to get a P11D, and they should, if they've got no other adjustments going through their coding notice, have no outstanding balances due at the end of the tax year. But employees, if they see something strange on their pay slip, they're almost certainly going to ask. So it's worthwhile just having a Q&A session with your employees, or even having like a frequently asked questions document and sending it to your employees prior to actually implementing payroll benefits for all your staff. And that's essentially what I would say are the main points for employers to be aware of and things to do now. Just going to quickly go over the key message, and that's that the UK is moving from the dual system, which is currently P11Ds plus optional payrolling or optional payrolling, to real-time payrolling for most benefits in kind. Obviously, we always refer to that as PBICs. The mandatory start date is now the 6th of April 2027. As I said, that was previously expected to come in on the 6th of April 2026, but the revenue have pushed that back, partly because I don't think they've actually provided the software providers with their criteria for what needs to be reported, but that's where we are. It's not mandatory until April 2027. Again, some benefits, for example, loans and accommodation, are initially excluded, but I expect that they will come into mandatory payrolling of benefits in the coming years. There will be significant operational systems and communication work required well in advance. So again, don't leave it to the last minute. Start thinking about this now. Whether or not you decide to payroll benefits from the 6th of April 2026 or wait until 2027, but at least start thinking about, actually, this is coming in. I can't just wait until the last minute to worry about this, and have a plan in place. As I said here, use this lead time to make sure that your systems are fit for purpose. Train your staff up and make sure that they're aware of it. And yeah, ultimately what this change is aiming to do is to simplify reporting. But as with anything, simplifying from the revenues perspective doesn't always mean simplifying from the employer's perspective. So there will be an added admin burden for this, and it's worth kind of sorting out these problems now while it's not mandatory. It's still just an optional position. But again, like I said, transitional risk is real, so be aware of it. And that's all I kind of wanted to go over. Essentially, if I was to do a very quick summary, I'd say there's no change from where we were last year in terms of payrolling benefits, but the mandatory is coming in a year later than expected. That's essentially where we are with payrolling benefits. Does anyone have any questions? Sorry, I should have said if you did have any questions, if you could put them in the Q&A box, but if we don't have any questions, but if anyone has any questions that they want to ask offline, my contact details and Avro's contact details are on the screen just now. But we'll just open up to questions now, if that's okay.
Yeah, I mean, probably, Richie, people need time to think about and digest all of this and maybe rewatch the recording.
Yeah, absolutely.
But we're more than open to receiving any questions that you might have. So I think if everyone's happy, we'll just leave it at that. And please enjoy watching the recording again, I'm going to send you a link along with the recording. I'll send you a link to some more national minimum wage information. The P11D position, payroll benefits, is still developing, so we can't really send you a link on a final position on that. That'll come in time. So that'll give you some, the recording again and some more minimum wage information. Please do feel free to follow up if you want to talk through your own queries or concern on how you want it to operate in your own business. With no further ado, we'll just thank you for coming along today and hope you enjoy the rest of your day.
Thank you.
Thanks, everyone. Bye-bye.
Thank you.